Hello and welcome to Moneycontrol. Well, the markets are giving us absolutely no reason to cheer. This morning we had some sentiment booster in terms of news on India-UK FTA. The market sort of opened on a strong note on the strength of that, but they've fizzled out. Nifty is now in the red. What is it that is keeping this market struggling? This is clearly turning out to be the most dramatic negative sentiment we have seen in years in the month of January ahead of the budget. To understand what is worrying the market and where do we go from here, we have Samir Arora, founder of Helios Capital. Samir, thank you so much for joining me this morning.
Good morning.
Tell me, what is it that is not so good morning, and that is becoming a routine in January, right? All of this year, pretty much not so good morning. Tell me, why is it that market is struggling so much? I mean, today one would have expected that at least some optimism will sort of, there were some results which were not so bad. There is some good news and sentiment booster in terms of the FTA, but the markets don't seem to be cheered by any of this.
So I think first is, the fact that the prices are falling itself sets up the tone, which means then you try and justify it and then you will find more bad things. And that is why to change that sentiment so that the chart, not the chart technique, but just the prices. For example, we seem to have absolutely let go of currency, for example. So if every morning when the rest of the world, every currency is weakening against the dollar, we open some 20 basis points high and then if that goes down to 10, that itself makes it look as if there's a bigger problem and a bigger problem. And I think one part, not the whole thing, is that the government and Reserve Bank of India have to decide whether they think that they can control it in the end. In the sense that you may say that we want, let's say, a weak currency. Nobody wants a weak market, so can't say it for that directly. But let's say we want a weak currency. But if somebody thinks that we can let it go that far and then we will back off or then we will support, if these things go out of control. In some sense, it is the same thing with the market. If we feel that, okay, markets have to correct, they have to correct, and therefore it is okay, and we will not even talk about it, we will not explain it, we will not give some rosy situation, some update, then things can go out of hand. But in general, the issues are the same, that the FIIs are not returning because they are doing well in other markets. That is the primary big picture reason. Now we can say Indian companies are, or Indian markets are more value, highly valued. But if you look at it at the end of 24 or in the middle of 24, things were okay and we were still relatively more expensive. Now we are definitely less relatively expensive. But it is that the other countries are doing well and therefore the world has not found a reason to change that momentum for now. That is, sell some of those markets to buy India. But plus minus, now of course these things are very painful in the meantime, but plus minus a few weeks, we hope that these things turn, primarily because they always turn. In the end,
Right.
either the valuations would have come down or earnings growth would have come up. But generally, these things are very rare. Very, very rare means I have not seen in 30 years that India keeps going down and the rest of the world keeps going up, and our currency keeps going down and the rest of the world, other than dollar currency, keeps going up. This is little bit has to be that we are letting these things happen, at least on the currency side. And I think that is setting a tone for everything else also. Not the only reason, but it just shows that where we can do something also we are not doing.
No, why do you say that? Rupee is slightly tricky because, from a policy perspective, maybe the government and the central bank want to offer some sort of a balancing picture
For exporters.
to the exporters,
For
some sort of
exporters.
support
Let's
to
say for
exporters,
exporters.
right?
Correct.
That is obviously in conflict with, how foreign investors will look at their
Correct.
return equation.
So I'm saying, I agree. I'm saying, let us say you want 5% depreciation. Is it necessary to do 1% per day in 5 days and panic other people? You do whatever you want, but let it be gradual. This is embarrassing. what is happening these days on the currency is embarrassing. It's not this much outflow. For example, now if you made money on dollar because of gold reserves or whatever, the bottom line is that the reserves are $700 billion. So to make it look that we are at $100 billion and that every day when the rest of the world is having stronger than dollar in terms of currency on those days to be down on when the markets are closed and the rest of the world is rejoicing, then next day we open, we are down. That's what I was saying in the beginning, that we should not think that these things you can control beyond a point, because there is a chain reaction on other things. One of them is that people in equity markets believe that there is something wrong, there is some problem, and I don't think there's a problem. So if you overdo
Yeah.
anything by thinking that at one point when it hits X, some 92.83 is my target, and at 84 I will try and tell the market that no, that doesn't happen. This is becoming a bit too much every morning because before equity markets open, the currency is on a good
Yeah.
day for currencies, we are up 5 basis points. That becomes a bit of a bad starting this thing for the world. And then they say, okay, let's forget about today and move to tomorrow.
Right. On a day basis, what you're saying is correct. But Samir, how does the overall return math itself look? Because the fact that now you have to factor in additional depreciation in the currency, and the rest of the currencies are actually appreciating. The dollar is
That
actually
is what is
depreciating
upsetting
against
more
most
than
of the other
anything.
currencies, right? So today, this year, if you look at the relative position of India, looks to be weaker because you have this new currency dimension that is emerging.
So, so that's what
So
I'm saying.
does that
Normally,
sort of
no.
postpone our? Yeah, please go on.
So normally we would have felt that after this depreciation, which is say 5-6% over a year, that things will normally stabilize, primarily because in the past
Yeah,
depreciation has happened in spurts, and then it is stable for a few years and then again it happens. And the average still in the end is about 3.5% per annum, which is fine. But that 3.5%
right,
happens A, with some clear reason that this is what is happening, this is the world here. And that normally happens when dollar also is strengthening. In this case, the dollar itself is
right.
weakening, gold is going up, everything is going up, and we against say euro and others would have fallen 18-20%, because the euro and all are up
Yeah,
maybe whatever
absolutely.
12% against the dollar. So we have to have some sense that okay, 20 is
Yes,
enough, 18 is enough, but more than that, even if we want 3 more percent, it doesn't have to happen in January and first 3 days of Feb. So anyway, we are not currency guys. All I'm saying is
right.
that is just a bad starting point. But on equity side, the
Okay.
issue is
So
that
does
we did some trick. Yeah, sorry.
so should we keep aside any hopes of FIs returning to this market anytime soon?
No, I didn't give up those hopes, because my feeling is that India, let's say big picture, India is some 0.5, 0.75% of the world. And if 98, 99% of the world is doing well in terms of stock prices going up, it is not that this 0.5% has to be sold by somebody to, invest in the other 98%. Or if we say that it's an emerging market portfolio, which means around 15% is the index weight, that you have to sell from this 15% every morning, literally every morning, to invest in the rest of the world. Because sometimes people will say the market has corrected a lot, sometimes there'll be some reasons for them to average on their particular stocks. And sometimes the guys may not have started with 15%, and they may say that let's lock in our relative this thing. So these things don't stop. It just so happens that right now things have this
Right.
thing where the rest of the world has some reason to do well because
Yeah.
tech is doing well or whatever. But we need one or two triggers, and could have been the EU, and I think it's still there somewhere. It's not that it's over. And then, Scott Bessent said that the extra 25% may not be can be removed, because Indian oil and gas company, I mean these BPHP types, have
Yeah.
reduced, and also budget some little bit angle on whatever things they can do.
Yeah, we'll talk about the budget, but before that, this India-EU deal, how are you playing it from a market perspective? Because there are a bunch of gainers that people are talking about in terms of pharma or specialty chemicals. Is that cohort looking good to you?
We are not changing for all these things because later on we'll discover that the actual implementation of the deal will take 12 months or something. And anyway, we are invested wherever we are. No, no, it's not. These things are macro things from a point of currency stability, economic stability, and for many companies, many companies, maybe even unlisted, to find a way to replace US. The another angle is to show to US that if you don't do a deal with us, we can sort of go around you and find other markets. These are
Right,
more big picture things. You're not supposed to literally go and buy a stock on this basis. Separately, one
right.
stock.
So it doesn't
Market in
change
general, I
anything from
agree.
a listed perspective.
Market in general, it helps. But you still go and buy what you like rather than
Right.
something oriented towards the India-EU deal or something. That's what I mean.
Right. But on the contrary, you've always been bearish. I mean, for quite some time, you've been bearish on the auto sector. Now, this duty cut that they are, talking about, you think that makes it even more negative, or was this always part of your
No, no,
equation?
mine, this won't change much because the number of cars that come above, say, 25, 30 lakhs, because if it's 15,000 EU plus you put, I mean, euro plus you put some 40% plus you put whatever, some GST, this, that, it'll come to 25 lakhs or so. And 25 lakhs and above, the number of cars sold in India is some 7, 8% of Indian cars. Okay, so from that you take, okay, some 2 3%, and that means some 20 30% that will be reduced. So for some of these guys, it might change the profit by 3 5% or something. It's not that. My point always was
Right,
that these things should not be protected beyond a point, particularly for higher end things, because they are not disturbing the rest of
right,
the system. And also, when we want
right,
our things to go in other markets, you have to make some deals, and this was easier than others. But it also is a good point because now US, at the very minimum, will want similar things for everything. I assume that Indian EU deal would have said that now US can't get anything better than this because the first guy who signs
right, right,
will
right.
have. So I guess the US cars will also be
Gets
allowed
that.
at 40%. Yeah,
Right, right.
one
No,
day.
no. So today I'm asking this question also because today Mahindra and Mahindra, Maruti and all are struggling this morning. I mean, they have, of course, one day doesn't mean too much, but
Yeah, yeah, that is
incrementally this
headline
year, because
thing.
one of the sectors we right. So 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 you continue to be bearish on autos, right?
We don't like auto as in four-wheeler auto. Yeah, we don't like. First of all, when we say we don't like, what are there? There are two companies because there are total three: Mahindra, Maruti, and Tata Motor.
Yeah, yeah, yeah,
And
yeah.
for different reasons, we don't like
That's
them. So
right.
it's not that there is some big universe of things. We like the ancillaries. Also, ancillaries don't have they have these sectoral tariffs. They don't have extra 50% tariff, even when they're exporting. And you can play them more neutrally, whether somebody, who's the winner, who's the loser kind of thing. So, yeah, we don't have these on the long side, the auto guys, but we have the EV guy. I mean, the two-wheeler, and we have Hero Motors now. And we have
Yeah.
Ather.
Right, right. All right. You have been pretty vocal, especially after the last budget, you were pretty vocal on, this capital gains tax. And I see that there is this very strong narrative that is emerging now. A lot of debt guys, including bankers, are voting for, parity between equity and debt taxation. And you were the first one to voice last year also that this, hike to 12.5% itself was bad news.
Way back.
How do you see this? Yeah, first of all, do you expect anything of that sort in the budget? Are you prepared for like a slight increase in capital gains tax for equities?
If there is
And what is
a
your thought?
if there's an increase in capital gains tax, basically the FI funds will all close down, I think, over time. So it's not a very normal thing to have an increase. We don't
Close
expect a
down. You're saying
reduction.
all the
Yeah, yeah,
FIF.
because nobody can work. Nobody
You're
can work. How to justify to the world that you invest in US and you pay no tax, and you invest in India and you pay 15, or say if it is increased. I'm saying let's not go there, because with a 15% starting handicap and a currency which is expected and is currently live while you are doing the budget down 2% this month. Please explain how we as marketers of funds expected to tell the foreigner that you will overcome the tax and you will overcome the currency, and then we want our fee and performance fee and many other things. So it won't work, but let's not go there, because I don't think that is happening. What we are saying is there are two angles if you want. First of all, I don't expect anything to change. Just because I write on Twitter doesn't mean I want.
right,
There is a difference between what should happen and what will happen. The should is different.
right,
So
right,
let's
right.
go in the will part. So the thing is that when these debt guys are saying that there should be parity, the problem is that there are
Yeah.
two sort of interested parties. One is the foreign institutional investor, and the foreign institutional investor does not pay in other markets. So if you increase the rate, then this difference becomes too much. And secondly, because this is charged when you have rupee returns, and then there is the depreciation which is post that, then the returns become very, very low in normal situations. If there's a big bull run, nobody cares, you're still doing well. The other is
Right.
between Indian equity, for Indian investors, between equity and debt. I think people are getting carried away if they feel that there is too much equity money. We, whenever we get some good stuff to think that this is how it will be, it is part of the reason is the tax. And part of the reason is we want
Yeah.
equity money. So if the debt
Right.
guys want, they should say, you keep the 12.5%. I'm saying reduce it, but I'm saying from their point of view. And over time,
Right.
reduce the debt, this thing to whatever, 20%, 15%. By the way, that the person so if we get interest income and my tax is higher or
Yeah.
whatever, please note that the guy who paid me the tax, the interest, which means the corporate, he took it as a deduction.
Has paid.
So he saved tax. So
Yeah. Yeah.
collectively, equity is not the same as debt. To say, oh, my debt income should be taxed because should be taxed low, because the guy who gave me that interest himself took a tax benefit. Whereas in equity, when I made the gains, it's not that the other guy took an equal and opposite loss. And plus, the ultimately what the equity guy got, which is dividend, came after the company paid tax. Then there was a dividend tax, whoever paid, and then you got it. So to say that it is equity and debt is the same because in USA it is the same, there it is the same, has no meaning, because everything that somebody else is doing wrong, we don't have to copy unless we copy everything that they do, including not charging
Right,
tax to
right,
foreign
right. No,
investors.
but your logic is not complete with equity and debt, because even in equity you can always argue that capital gains arises only because the company makes profits, and the profits guys have paid tax, right?
I agree. That's what I'm saying.
Uh,
I'm
the,
saying
the, the
the
companies which
equity
make
guys have
profits have.
actually been taxed. It's the exchange of that. So the underlying equity has paid tax, that is a profit. And then these two people exchange this. So for that, one guy who
Right,
made
right.
money is paying tax, but the other guy is not taking an offset for it. It's not that one guy lost, he just didn't make that
Correct,
extra
correct, correct,
money. Whereas in debt,
correct,
when I
correct. So
am
you're
paying the
saying
tax, the
total
other guy has
capital
taken a
gains
tax hit, tax loss.
deduction. Correct, correct, correct,
Deduction, I mean,
correct, correct.
deduction loss, whatever. He's
Okay.
taken it. So in the
Yeah,
end,
yeah. So
uh, you get more money out of equity guys
you're
anyway.
just saying that, yeah, yeah, yeah. Fair enough, fair enough. That's an interesting way of arguing this point.
Not
What is your
interesting
favorite
way. That
hunting
is the
ground
way.
now? No, no. I mean, who adds a profit, corporate profit tax to capital gains tax and looks at total I mean, we're not used to looking at it that way. logically it makes sense.
Philosophically,
I hope the
philosophically.
policymakers are listening to this. Yeah, yeah. So, quickly looping back to anything else you expect from the budget, and given that we have not seen any pre-budget rally, what do you think could be the factors that could lead to a sell-off? And on the contrary, is there any triggers that you will look for which will sort of change the market's direction from there on?
So, first of all, I think that the probability of a sell off beyond that is also less now because A, it has already corrected a lot because the rest of the world is doing well, quite well, and the relative performance has become embarrassing. So, embarrassing means it's become very wide, and therefore, this reversal will happen plus minus for some trigger. Because the difference between how, as I was saying, if 98% of the world is doing well and or 85% of the emerging market is doing well, for us to imagine that this 14-15% has to be the funder of money that is put into Korea and Taiwan and all also is a bit too much to think. And in terms of positives, of course, EU deal is a positive. I'm just joking that we don't have to change the stock, but it's positive because it also makes it
Yeah,
easier to do a US deal. It also makes it easier to say that we will still be earning foreign currency, if not dollar, euro, mix and match. And thirdly, that the Indian exporters will not suffer from loss of jobs and all beyond a point. Today, I saw one of the textile companies on your sister channel saying that they are still fully booked even with US orders up to the first quarter of the next
yeah, yeah,
financial.
yeah.
That means April, May, June. That means things are, they might be making no
Right.
money, but things are there. Somebody also
Yeah,
told me, one of my friends, that Walmart is seriously buying from India, even with the 50% tariff. And then whoever was selling them, whatever textile said, but why are you still ordering from India? And their thing is that it's a longer term thing. If 6 months may they import a little
yeah,
extra or whatever, it doesn't matter because they have to start someday. Because there is a genuine this thing to go beyond China. And because they also must be imagining that
yeah.
3-6 months these things will happen. So why completely stop our export even with a tariff? Because
Sourcing
anyway, the
relationships.
percentage today will be very low and all that. So what I'm saying is there are many triggers that you can find as long as the budget does not try and do what you are saying or what these guys are thinking, that
Yeah,
the equity debt narrowing means that equity capital gains even have the word in terms of positive. Not today. If you say 5 years later we will change it, it'll be very negative. I mean, if you say it'll be increased 5 years later to bring in line with debt, it'll be a very big negative because that would mean that the argument has not been accepted by the government that A, equity flows are good. We don't have enough equity flows. These jobs, whichever jobs are being created, whatever houses are being bought, apartments are being bought in Bangalore from private equity guys cashing out, all that is happening because the equity market is giving an exit to the initial guys who are private equity guys. If private equity guys are not there, normally they used to be FDI. When FDI comes in, A, it is a longer process. They take 5 years, 10 years. They are strategic. It is not owned by Indians. And they are basically becoming landlord. When an Indian fellows companies funded by private equity, after some time, it is mostly held by the market, maybe after 10 years, 15 years. So everybody in India owns it. And the private equity guy is not bailed out, but exited because the public market guys and the FIIs buy it. So in the end, this whole thing is a
right.
cycle. You can't say FIIs, what do they do while they buy? They are just trading. What does the Indian public do? They are just buying, selling shares. No, they are helping the exit of the guy who sort of got the company started. And it's all a cycle. And to think that we have too much equity capital, from where did we come up with this idea?
No, I mean, there are, I guess, both sides of this because other people argue exactly for the same reasons that you're batting for it. They argue the other way that, so much money coming into markets and people getting, taking these easy exits, which is
Which
also driven
exit?
by the favorable taxation for equity. Yeah, I mean, all
See,
these multinational companies taking out
the
money or
point
private
is that
equity
the
guys taking a.
No, no, no. The private equity guy, you have to see his total return. Don't see the return of his successful exit, which means on whatever company goes to the public, by that time he's made a lot of money in that company for sure, because that means that company succeeded. So he may make 5 times, 10 times. But please look at all the other companies he funded. So he funded maybe 10 companies and two went public. And on those two, visibly, you can see that he made 10 times. But if you look at the eight that basically went to zero, because you just imagine how many startups in fintech were there in, say, about 2 years ago. I think I came on your Diwali show once and said that 100 of them will go
Yeah, yeah.
bankrupt. And they were, that means more than 100 at that time. Now you find six. So what happened to the other 94? Maybe 10 of them got bought by this fellow, that fellow. 65 have gone to zero. How many food delivery guys started? Maybe 10. So all those guys have
Right, right.
disappeared. That is also being paid by the same private equity guys. So the best thing is ask for their return in rupees. It'll be 15-18% only, which is more or less like any regular publicly this thing. And so don't look at only the successful exits. They are very few.
Fair,
And although the proportion
fair
of
enough. One
return
last
looks very high
question.
in those deals. Yeah.
I anyway love your ingenious, new, ways in which you invent arguments to defend this case. It's all absolutely logical, and I go with it. One last question on, what is your favorite hunting ground now? For quite some time, you have been bullish on banks, and of course, a bunch of new age companies. Anything that is looking interesting now, especially after the way the markets continue to
Right
correct?
now, my
Are there
number
any
one and
particular pockets that you?
right now my number one and number two ideas in India are quick commerce and cash payment or fintech company. Both are listed. Both we have. Both are very good, and they will grow a lot, and they are well placed to continue to grow.
Anything else?
Anything else, because now we have so many funds and we from offshore have three funds. So there are many stocks we buy depending on the mandate. But if you say big picture, which is, relevant across the funds or for somebody buying personally and, having say 2-3% of his portfolio, they're 4%. These are the ones. Otherwise, nowadays, there are many more stocks in our portfolio. But I would say top of the head, these are the easy, simple ones where somebody can analyze, they can check, they can experience it themselves.
Cool. All right. Thank you so much, Samir, for joining this morning.
Thank
Absolutely
you.
delightful talking about capital gains and your arguments for it. Thank you, and
Thank
have a good
you.
day.
Thank you. Bye.
That's all. That's all on the edition this morning. Stay tuned to Money Control for all your news, views, and market updates.